Hello, you're watching Trading Day on BNN Bloomberg. I'm Amber Kammerer. We're watching these markets. It's all systems go on the TSX, which looks like it could close at a record high if these gains hold. Gold is a big part of that story. Gold producers are surging here as we've got the price of bullion moving to new record highs. Let's bring in David Burrows, President and Chief Investment Strategist at Barometer Capital Management. David, thanks so much for joining me. What do you make of the move in gold? What does it tell you about sentiment?
Well, it's funny, Amber. You know, I've over the last 3-4 months, every time I've been on, we've talked a little bit about gold, and I always have to say, you know, we're not gold bugs. I'm certainly not a gold bug, but there's a time and a place for everything. And gold has clearly come into cycle. Now, for one, we've had an ECB cut. We're now going to have a cut in the U.S. We're into a loosening cycle. That's certainly favorable. It is clear politically that almost nowhere our government's willing to cut their spending. And so there's just been tremendous fiscal spending. That also kind of supports gold. But realistically, you know, when it's been out of favor for many years and slowly working its way back in, investors are skeptical. And I think that's why for most of the year, gold stocks sort of underperformed what was happening in gold itself. But to me, it looks like we've really entered an upcycle for gold.
So let's talk about how you plan on playing that. You can get that through pure gold bullion, or to your point, you could take a look at some of these gold miners, which recently have started to keep pace with the move that we're seeing in bullion. In fact, year to date, the XGD, the gold mining ETF, has outperformed. Do you have preferred names in that space?
Yeah, so we're there. We have 3 companies that we own across portfolios. Sort of our criteria is we want to own producing companies with good management teams that are generating cash, that are in geographic regions that are not scary. Geopolitical risks are ripe in gold mining. And so we focused on companies that we think institutions or individuals can own. So our 2 big holdings would be Agnico Eagle, which is sort of the institutional go-to name, and Kinross Mining, which over the last week has had some good news on one of its developments. And then we own an emerging producer, Alamos Gold, AGI. All have been outperforming the sectors year to date. They all generate cash, and all have some pretty interesting opportunities here at about $2,500 gold.
$2,500 gold now. How much higher do you think it can go?
Well, you know, I am a technician at heart. You know, everybody will say sort of $2,700 is the first target. My guess is if we are picking up the head of steam that I think we are, we're going a fair ways higher than that. And that has a big impact on the cash flows. These are high fixed cost businesses. And once you've got prices, you know, well north of their fixed costs, the profitability really kicks in. So like many, many other commodity producing industries, management groups in this business have said to their shareholders, look, you know, we are going to generate cash. We're not going to blow it all. We're going to be careful with the cash that we're generating. And we do think that we're in a market where there's 2 kinds of risks, right? One risk is falling prices, and we lived in a disinflationary world for many years. I would argue we moved into a more inflationary world, and while it's going to come in fits and starts and it's pulled back a little here, the likelihood is that inflation is going to be with us for a while. So we need to own hedges that offset the impact of inflation, and gold is one of those things.
Do you think, given that, we could see some pickup in M&A activity?
Well, for sure we've seen that. You know, the old saying is the first thing you watch for is gold companies mining for gold on Bay Street. And we've certainly seen that. We've seen 3 or 4 intermediates get bid for and purchased over the last 3-4 months. And I think that that's likely to continue. And that's why some of the intermediate producers are pretty attractive, because nobody's finding new gold. I mean, whether you're looking at copper or looking at gold, you've been through a long bear market. There's no financing available for smaller companies. And once there is financing, you know, the regulatory regime is so difficult today that it takes 15 or 18 years to get a mine into production. So The easiest route at the beginning is for the large cap producers to purchase intermediates, and that's happening. And then you can expect to see financing pick up, and you'll start to see juniors get financed, and that's how the cycle unfolds.
So, as I mentioned, it's a large part of what's taking the TSX to these all-time highs. We haven't seen all-time highs for the S&P 500 since July, and I'm wondering if the things that make the TSX in vogue right now, value, dividend, gold exposure, is that sustainable? Do you look for more outperformance in the Canadian markets relative to the U.S.?
We always look at assets that underperformed for a long period of time, but where something's changed. And if you look at the Canadian market, it looks a lot like international stock markets, ex-US, partly because if you look at sort of the MSCI All World Index, ex-US, it's dominated by financials and industrials and materials and energy. And these are four pretty important sectors for the Canadian market. So the Canadian market has a lot more correlation to global markets than it does to the US. We know that the TSX basically went sideways from 2007 through 2020. And it is now outperforming US markets, partly because the sectors that are performing well are sectors that make up, big parts of the Canadian market. I've looked this morning. Of 1,500 North American ETFs, one made a relative strength new high versus the market. In other words, making a new yearly high relative to the indices and relative to the S&P 500. It was the Canadian Equal Weight Banks ETF, ZEB. So that tells you, finance is a big part of our market, and they are performing well. And frankly, capital markets banks in general have been outperforming in the U.S. On Tuesday. Two capital markets banks ETFs hit relative strength new highs, and specifically broker dealers and asset managers. Again, those aren't things that should be making relative new highs if we think we're headed into some kind of a hard recession.